So gold seems to be getting a little illiquid here. On the Comex side of the market, on the 𝙎𝙬𝘾, it looks okay. We haven't had nearly as strong a runoff. So perhaps people would be going more to the London market for their deliveries. We'll see what happens.
Welcome to Gold Silver Pros.
Hey everybody, this is your host, Rob Kientz at goldsilverpros.com. Recording this on December 18th, 2022, and this is your weekly market wrap-up. I want to dive right into what we saw happen during the week, and we're going to start with the gold and silver price. They were about even on the week. Gold ended in 1790s, silver just above 23. A slight decline over the week, but overall you could pretty much call it even and be just about correct. Major news came out in the economic data this week I really want to talk about. A lot of it has to do, I think, with confidence as a system, and I think now we're starting to see deflation show up and rear its ugly heads. You're starting off with the big number, which is consumer inflation year over year came in at 7.1%. That's about 2 percentage points lower than where it had been the last couple of 3 months. I think last month we had a reading in the 8%. So it has been coming down for the last few months, and we warned that that could happen when we get to the deflationary stage of the inflation cycle. It goes in stages, usually 3 waves of high inflation followed by deflation. And we think that that's where we are right in the middle of it. So that went down. But in addition, the import price index went down, which means the prices that we're paying for imports have gone down as well. So it's not just a deflation in prices here or productivity here in the US. We think we're also seeing that from across the pond as well. We did see a little bit of strength in the jobs numbers. Initial jobless claims are down to 211,000 on expectations of 232,000, so not bad. But all the manufacturing and the sales data does not look good. Retail sales down 0.6%, excluding motor vehicles, still down 0.2%. So automobile sales are really down. The rest of the economy is down as well. Empire State Manufacturing Index, that's a New York manufacturing, is down double digits, minus 11.2%. Philadelphia Fed Manufacturing Index down almost 14%. Both of those are much lower than what economic pundits expected. The Industrial Production Index is down 0.2%, and the capacity utilization rate is down to 79.7. And that means our economy is not producing nearly what it's set up to. We have about 20% slack in the system. We have manufacturing crashing. We have home and auto sales crashing. And we have inflation coming down. We're in a full deflationary cycle. I do believe business inventories have ticked up 0.3%, something I showed on the program this week. I talked about business inventories also on the 𝙎𝙬𝙊𝙎 blog, where I talked about how we're ramping up inventories even at a lower capacity utilization rate. We're not using 20% of our economy. That's the slack. We're still building inventories, which means the consumer has stopped buying and the businesses have stopped buying. The S&P U.S. Manufacturing PMI Index is down to 46.2. It's below expectations of 47.7. And the U.S. Services PMI, this is the Purchasing Manager Index, the feeling of Purchasing Manager Index of future growth, essentially, is at 44.4, below expectations of 46.5. So the economic data did not look good at all this past week in terms of growth of the economy. It looks like deflation has hit a square between the eyes, and we're going to see how long that goes for before we hit another inflationary cycle. Remember, this all goes in cycles. We're going to hit inflation, deflation 3 times most likely before we get resolution in this recession. Building and housing starts come out next week. We also have some data on the gross domestic product. We'll pay attention to that. Along with the theme of productivity, capacity utilization, was an article in CNBC. Mark Benioff, the CEO of Salesforce, tells workers that his new employees are facing lower productivity. They just spent 32% more on their employees recently, and they're having to lay a lot of them off. And he thinks in this article, it's documenting how new employees, because they're not coming in the office and their remote work, are not integrating with the existing employees as much. And so their tribal knowledge they build for the job is not building up, therefore they're not as effective. And this is starting to affect companies. And I do believe, 1, the great quitting, 2, also the remote sales force is causing problems with productivity in America. We're going to have to see how America adjusts to that. Will there be new software that comes out? Will we do a hybrid scheme where people work part-time from home and part-time from the office? Will we become more virtual in the tools that we have? We'll have to see what happens. But right now, part of the productivity issue is remote work and the changing U.S. workforce. Also, a nice little article here from you from Zero Hedge, looking at the Global Innovation Index. This is from Visual Capitalist, and Dorothy Neuville put this together. The U.S. is not the most innovative company. They are number 2 behind Switzerland. There is a rating based upon several categories: business sophistication, human and capital and research, institutions, infrastructure, market sophistication, knowledge and technology outputs, and creative outputs. And based upon a measure of all those outputs, the U.S. comes in number 2 behind Switzerland, which comes in with the highest rankings. The highest ranking, Switzerland is 64.6, US is at 61.8, just 0.2 points ahead of Sweden is 61.6. The United States, however, is the highest in North America, second highest in the world, and much higher than competitors Russia and China. Russia is sitting at 34.3, China is at 55.3, Australia 47.1, India 38.6. Most African nations were in the teens, with Namibia and Botswana ahead. Egypt is ahead as well in the low 20s. South Africa led the African continent, 29.8, Kenya at 22.8. Europe, the highest, again, Sweden was 61.6, Germany at 57.2, France at 55, the UK at 59.7. Most innovation still coming from the Western world, although the Eastern world tends to be catching up just a little bit. There is the news for you this week. I want to get into the precious metal side of things, so we're going to start talking about the data that we see on the Comex. And we're going to start off with gold. Here's the volume in OI. Of course, when you see low volume here ending up December, it means we have less trade. Most of the trade is moved to a future month. That month is February, as you can see by the contract data here. Not much trade going on in December, although people are still taking deliveries. Another 351 physical deliveries came off the market. There are only 348 contracts left for December. So we don't expect to see too many more deliveries for the year. Maybe the last 348 will deliver or cash settle. 360,000 contracts traded on Friday for the February contract. And we're going to see what the settlements came in to look at the price. Up $12 on Friday's data, almost $13 to close at 1,820 cents on strong volume on Friday. We look back to Thursday. We were down $30, however, the worst day of the week on volume of 186,000 contracts. That's where gold ended. Let's look at silver. Again, volume and open interest is down as interest in the December contract wanes as we get more towards the end of the year. Not a lot of deliveries to speak of. One contract delivered, only 1,113 left open. Not very many trades on December. The next big month for silver is in March. Gold is February, silver is March. 108,000 contracts closed. There were exchanged for physical to the London market, 889, and no deliveries to speak of. That was Friday's data. If we go to Thursday's data, again, 108,000 contracts, not super high, just healthy trading to end up the year. Not any deliveries. EFP over to London, 605. We're going to look at the Commitment of Traders report through December 13, 2022. This is the data that made up what we see here in the trades last week, because this is about 5 or 6 days old. When we go down to silver, what we see is the swap dealers have now gone net short. That's right. The bullion banks have now gone net short silver. They're now in more of a short position. So I expect that raise in silver price above 23 will kind of cool off just a little bit, because the banks are almost net even, but slightly net short by about 800 contracts. The producer merchants are still long net short because they're protecting their downside price risk, with some of the merchants protecting their upside price risk, that having to buy silver in future months. The managed money is still predictably long on silver, expecting the price to go up, and the other reportables, being the wealthy family offices, have added a lot of short positions, adding 1,700 this week and dropping 1,000 longs. I think they also believe the market is frothy. So the bullion banks and the smart individuals and family offices are going slightly short, which I think means the silver price is likely to cool off just a little bit here in the next week to 2 weeks. We'll see what economic data comes out that may change that. In gold, not much has changed. Swap dealers are still massively net short. They added 11,470 more short contracts to 1,910 long, so more interest overall in the market, although more net short by 10,000 contracts. Predictably, the producer merchant category is still net short. The same reason net short silver is protect downside price risk. The managed money is almost double net long, not quite. 103,000 contracts to 66,000 contracts short. added another 10,000 long contracts, managed money. The financial houses are definitely expecting gold to go long here on the flagging economic data. And I have to say, I don't disagree with them based upon the economic data we see and the deflation that we're seeing. Gold tends to do very well in deflationary environments. Managed money has apparently gotten that memo. Good for them. Other reportables are net long by a factor of almost 4 to 1. 120,000 long gold contracts to only 32,000 short. And they, I believe, are also smart money in the gold side. I wanted to look at gold in particular this week. We've talked a lot about silver being run off of the various exchanges and indices, including the Shanghai, the London LBMA, and the CME Group and the Comex here in the United States. Well, we haven't talked a lot about gold, but it's been run off a lot this year. Look at the runoff in gold in 2022. This is a massive amount of gold ounces coming off the market. And I want to do a share screen on the actual inventory stocks. We don't do this too often, but I wanted to do it here. Here's a spreadsheet directly from the CME Group, and this is as of 12/16/2022, so the latest data that we have, that'd be Friday's data. And if you go down here to the bottom, the one number I have highlighted is that we only have in the liquid gold on the market, the liquid gold that is put up for delivery, for actual physical delivery in Comex, we're down to under 12 million ounces. That's 11,715,000 ounces. That's not a lot, and an additional 11,508,000 ounces ineligible, but a lot of that's private contract and may not be eligible actually, or may not be liquid enough for actual trade. This is getting to be a really low number in gold. We don't have a lot of gold on Comex. Could we get a run on gold before a run on silver? That would surprise me because of the way silver had been reacting, dating back to Silver Squeeze. It had been running off faster. We're now to 33 million ounces in total registered, although that number's actually come up some in the last 4 weeks. So we've actually had a net inflow, a slight inflow over the last 4 weeks into Comex for silver. And you have a healthy 297 million ounces combined. That's an additional 264 million ounces ineligible. We don't know how much of this is liquid because remember, eligible is private storage, and it could be private holders that don't want to sell it, or they're using it for something else, and it may not be liquid. We know that. So right now, we just know that we have 33.6 million ounces of liquid silver, although that's healthier than the gold market, which is down under 12 million ounces we saw on that graphic. So gold seems to be getting a little illiquid here. On the Comex side of the market, on the LBMA, it looks okay. We haven't had nearly as strong a runoff. So perhaps people would be going more to the London market for their deliveries. We'll see what happens in the future, but it does look like a little bit of a gold run. Again, the data last week, economic data, is pointing to an economic deflation cycle. I have put up the chart many, many times that talks about how this goes in three, how we have inflation and how we have deflation. I do believe that that will continue as time goes on. We will have a nice deflationary cycle. I think you're going to see demand destruction from the consumer, and I think we have too much supplies. So that supply destruction is going to have to start to occur, and that's going to lower capacity utilization in manufacturing. It's going to lay off manufacturing jobs. It'll lower shipping rates and amount of shipments, and that will affect the Chinese economy as well. In the manufacturing side, the economy across the world, in both Germany and China, I expect those to be affected because the U.S. will be buying less. We'll continue to see where deflation takes us and how the Fed in particular reacts. Have they tightened too much going into this deflationary part of the recessionary cycle? We think they probably have, and even reducing the latest rate hike to 0.5 percentage point or 50 basis points was probably not enough. They probably have over-tightened. I suspect we'll see the effects of that coming in the next few weeks. That'll wrap up this weekly market wrap-up, which we do every Sunday in the late afternoon or Monday in the early morning to get you started on your trading week on both Gold Silver Pros and 𝙎𝙄𝙇𝙀𝙍.com channels.
Searching for the best precious metals deal? Shop with our trusted partner, ARC Silver. Access special deals on silver, gold, and platinum through our website, or call 307-264-9441.
Everybody, I am back again with Ian to do the weekly metals update. Ian, how are you doing today?
I'm good, thank you, Rob. All the better for seeing you.
Well, Ian is on with us every week because he runs ARC Silver and has access to basically a lot of gold and silver that he sells out to the public, cuts out a lot of the middlemen and brings better deals. And one of the reasons we have him on is just to see what's going on in that physical market. What are you noticing there, Ian?
Yeah, it's on our side, it's quieting down on the small retail. The big buyers are still buying. People are still buying multiple 1,000-ounce bars. Companies are positioning company money out of dollars into bullion. So that's an interesting move, people protecting themselves privately and their companies. Premiums still falling, which is awesome for retail. Although when you go back, it seems like only a few weeks ago we were $18-19 spot. So with the spot increase, we're about flat. But when you look at it, Maple Leaf is cheaper than it was in August 2020. So it's on sale.
Yeah, and I've noticed there's a little bit of silver. It's come back on a Comex as well the last 3 to 4 weeks. So it appears as though what I'm seeing, in my eyes, price has gone up $4 or $5 here from I think 18 to about 23. Maybe some additional silver came on the market because we saw some ounces come back onto the exchange, and perhaps that's tempered, the demand just enough for premiums to kind of come down. How long do you think that will last? And to me, I think we're on the way to maybe $30-40 silver here in the next year or so. I'm not going to make a specific time call, but because of deflationary pressures I see in the economy, so I expect it to go up. If we expect silver to continue to go up, how do you think that would affect inventories?
Well, I think if 0.5% of the population realize what is going on and what is coming, and we'll talk about that in a bit, this slackness will last about 10 minutes.
Okay.
There'll be a stampede, as there always is. I mean, look what's happened in Turkey, still happening in Turkey, Zimbabwe, Egypt now, Austria, the Philharmonic, the government mint there, they said they could sell 3 times what they can produce just to their own population. And yet the Philharmonic is one of the most, if not the most well-known, oldest established gold coin. And they can't make enough for their own public. And Austria is not a huge nation. It's a rich, incredibly rich nation comparatively, but it's not huge. So, wow, when 0.5% of Westerners or, anybody with money wakes up and thinks they need to get out of fiat paper into real money, it's sold out in minutes.
Well, let's talk about what you may have for us on sale this week, Ian. And as you do that, I just want to hold up a shiny silver eagle. Love these coins. This one's a graded one, so we can get it to focus. There we go. This one's a graded silver eagle. Do you have silver eagles for sale as well?
We do. We have a whole load of MS69s. We have most dates from 86 through to 2020. I think we even have a couple of full sets if anybody wants a full set of MS69 eagles. And offers, we've got Maples. Sorry, that was a Britannia. So we've got
Maples. There's a maple leaf. Beautiful coin.
Yeah. Maples and
favorite.
Britannias. So if somebody wants a quantity deal, we are potentially below $4 premium now.
And you're beating everybody else on those premiums, you believe?
I hope so. Yeah, and that's on genuine spot. So remember, if you look at the other guys, they're adding between 18 and 50 cents onto their spot. So always get a live all-in price on the product you're looking at, because a 50-cent loading or even a 20-cent loading can make it look like they're 10 cents cheaper when they're 10% more expensive.
I gotcha. Thanks for the tip. And there's something interesting you and I were talking about before the program, and it has to do with the switch over to the new system. One of the reasons we buy the shiny is because we think it gives us an advantage when we get out of the dollar into whatever the new central bank digital currency is going to be, the electronic currency. But you had an interesting thought on that, a brainstorming exercise on what could happen, because aren't we going to have to switch currencies, and how does that actually work?
Yeah, I mean, as far as most of the public will know, we won't be switching currency. It will just be fully digital with no physical cash, and every transaction will be completely monitored, some sort of blockchain. I'm pretty certain they've actually got it ready. They've been bluffing when we're trialing it and we're testing it. I reckon they're ready. They want an excuse, whether it's a cyber attack or a pandemic or a plandemic, civil commotion, whatever it is, European banking system going down, British banking system going down, Japan, China, whatever the excuse, Russia pricing oil in gold, whatever it is, there's going to be a trigger. It doesn't matter which one it is, particularly, it's coming. And I believe the Federal Reserve is ready to take advantage of that and use it as a smokescreen. Oh dear me, we're going to have to shut the banks for a day or two to calm things down. Everything's collapsing. You know, pensions are in crisis. You know, all of the payment systems aren't working. Nobody trusts anybody. Then we'll get over probably a long weekend, maybe a Monday and Tuesday, and we'll wake up on a Wednesday and we'll be told your existing bank balances have been transferred into your new digital dollar, 1 for 1. What that will keep most people happy, because I bet there'll be a sweetener. I'm guessing something between $3,000 and $5,000 will be as a stimulus payment. But what will happen is larger balances will say, well, we'll have to hold off before we transfer those to things, because things have got to stabilize. So we just hold back. You've got plenty of spending money in your account. Everybody will get that 5,000. Nobody have an excuse to complain. But that sometime convertibility may never come, or if it comes, it will be on a reduced rate. It won't be at parity. And then on the alternative market, I think people with the new digital dollar will be able to buy the old dollars, but they'll be buying them at 70 cents on the dollar, 50 cents on the dollar, 20 cents on a dollar, till they revert to their fundamental value, as Voltaire stated, which is 0.
Yeah, and essentially what you're saying is there'll be a secondary market for old cash.
Yeah.
And if you need to settle an old contract, an old cash, you have to go buy that cash.
Yeah.
And because everybody's dumping it and trying to get rid of it and sell things, that it's gonna, it'll benefit the people that maybe have gold, silver, and they can convert either with their gold and silver, buy the new money and then buy the old cash, or just go straight to the old cash that way.
Yeah, and it's diabolically clever, because not only will it apply to wealthy individuals, it'll apply to foreign holders of another nation's debt. And if it's done simultaneously with all the major Western countries, who gets done over? China gets done over because they're holding $1 trillion. That'll be frozen. And then they may do some netting off deal. And if you think about it, it's no good just going to a digital dollar. If you just transfer all of the contracts, all of the debt, or all of the M2 or M3, which we're not even allowed to know what it is now, if that was transferred to the new digital system, it would still be just as crappy as the old system and would collapse just as fast as this system's collapsing.
They have to devalue out that old system to get rid of that old debt and get rid of the old system itself.
Yeah.
And that's the way it's always done in currency resets. They give you a new currency to devalue the old one. It'd be interesting. Yeah, it'd be some interesting to see how much pressure that puts on people if they're not able, to keep payments up. They're not able to service that. It seems like a big problem.
Yes, but we know the federal bank is not out for anybody's interests apart from their own. When their blatant policy is to increase unemployment, to stabilize the rise in prices that they've caused by inflating the money supply, which they've grown fat and lazy and greedy on, they have no concern of the consequences.
Yep. I agree with you. Ian, thank you so much for coming back on the program. If people are interested in buying bullion products, how do they reach out to you?
Yeah, we're 𝙂𝙊𝙇𝙑𝙊𝙎, and I think my phone number's on your website. I think, Rob, isn't it? If you go through the referral. Yeah.
Yeah, so if you go to goldsilverpros.com and just click on 𝙂𝙃 there on the website, you'll get a form which you can fill out and send to Ian, and he'll get that and he'll reach out to you. All right, Ian, thank you so much for joining the program. We'll see you again next week.
Okay, thanks, Rob.